G'day expats and welcome to another episode of Expat Chat. Expat Chat episode number 49. We're almost getting to 50. Today, instead of James Ridley, I'm joined by my colleague in the Dubai office, Jonathan Bonnet, who's one of the senior financial planners here. G'day, John.
G'day, Brett. How are you going?
Good, thanks, mate. Good, thanks. It's as you know, you're on the hood, you're in the sandpit. You know exactly what's happening. The days are getting hotter, and Mother Nature's giving us that big indication that summer's definitely on the way. So it's here, it's happening, and it's what we live in the desert. So we've got to accept the inevitable.
It certainly is, isn't it?
Yeah,
42 degrees.
Yeah, 42 degrees. It's a bit of a tough one to swallow, especially when the humidity's there as well too. So it's 42 and humid. It's you're alive. So before we get any further, I'm just going to get the disclaimer out of the way. All the information that we talk about today should be construed as informational, educational purposes only. Please do not construe it as personal financial advice. If you do need advice, please reach out to someone like Atlas Wealth Management. So, mate, today we want to talk about an article you wrote this week, and I think this is a great topic to talk about because it is so pivotal in a lot of people's lives right now, and it's how do you structure your estate planning issues with your parents. Unfortunately, baby boomers are getting older. We are seeing transfer of assets, and these days life is a lot more complicated than it was in the past. So what we're starting to see is considerations that were put in place 5 or 10 years ago aren't necessarily suitable now because the clients we're talking to, they're recipients overseas. So maybe what we want to do is talk about the good things to do. It's always a tough conversation to have with your parents. You don't want to sort of tell them what to put in their will, but sometimes they'll have good intentions and they'll talk to an Australian lawyer and he'll agree with those intentions, not taking into account the fact that our clients are overseas, receiving assets. So, mate, let's just run through. You did that great article on the blog, which I'll include in the links below on our website. Let's just talk through what's the sort of the first key main point that people need to be aware of.
There's a number of issues, and this is one of those issues, a bit like the onion. You take the skin off, and you've got another layer, and then there's another layer, and it just goes on and on. It's sort of when I was researching for this article, it was one of the few times in my life that I wished I was a lawyer, so I could actually get my head around the full implications of all of the issues. The basics is where people should start, and they should never lose sight that if you get the basics right, you're probably not going to have a disastrous outcome. But the complexity when you've got potentially beneficiaries in multiple jurisdictions is fairly serious and can impact upon all the beneficiaries. And that's the sort of the difficult thing for people to understand is that if you've got kids in effect in Australia, or your siblings, for example, are in Australia and you're in Dubai, and mum or dad dies and leaves an estate that's going across the group, that the fact you're in Dubai could lead to increased taxing across the whole group, basically whilst the money's still in the estate as it gets distributed. And there's things you can do to actually mitigate that, but it's sort of getting to that point to have a proper discussion around these issues. So, really well-structured estate plans will not have those sort of unintended consequences. But to be brutally honest, this is an issue that goes across even, it's not just an Australian issue, it's an English issue, it's an Irish issue, it's an American issue, it's the Spanish-speaking nations have got forced heirship rules typically across the board. So it's a big issue for expats no matter where they're from, but it is particularly under the, with the Australian capital gains tax regulations, it's a bit of an issue.
Yeah, you're spot on, because a lot of the time the default when someone walks into a lawyer and says, okay, I want to prepare my will and I want to look after my children, the default go-to is a testamentary trust. Let's roll everything in there. It's tax efficient, and one of the biggest key considerations that lawyer in Australia will have is protecting the assets, both in the in the time when someone passes away, but also from a tax point of view. Unfortunately, trusts are quite punitive for non-residents. So the whole premise and the benefit of having assets in a trust is null and void. And the reason for that is if you hold assets in a trust, that trust is deemed as an Australian resident person. So it's a digital person in Australia, so therefore it's taxed like someone in Australia. And where we get that dichotomy is obviously with respect to shares is a good example. So a lot of people in their baby boomer ages, they've had shares for a long time. They've had CSL and CBA and all the Commonwealth floats, Telstra 1, Telstra 2. Telstra 3 wasn't that great. And what happens is, as a non-resident owning those shares, you don't accrue a capital gains tax liability. As a resident in Australia, you do accrue a capital gains tax liability. So if you receive those shares in a trust, even though you're overseas and you shouldn't be accruing a capital gains tax liability, you're still accruing a liability because the trust holds it on your behalf.
That's correct,
we've got these different events, and to me, getting up front is a smart idea. Can you talk about this K3 event? I think you mentioned in the article.
Yeah, the K3 event is basically a capital gains tax that becomes applicable for non-residents, basically in an estate. So what effectively is happening is that the component that the non-resident receives or potential beneficiary receives is going to be taxed, but basically whilst that component is still inside the trust. So and in effect, the tax office is making a perfectly rational assessment of this. They're saying they're overseas. We want some tax revenue out of this. But we don't want to send it to them hoping they'll send the tax back. No. So they tax the estate. Now, the issue is, of course, and in a sense, if you take it in isolation, that makes perfect sense if you're sitting in Canberra, in your desk in the ATO. The problem is for the other beneficiaries. Now, the other beneficiaries don't have to pay tax on those assets that are transferred until they actually sell them. They still have to pay the tax. There's no getting away from that, but they get the 50% discount.
Kicking the can in the road.
But what's actually happening is, of course, your Dubai beneficiary, receives a third of a share portfolio. The capital gains tax on that third is basically billed to the rest of the estate, and then the rest of the estate will have to pay tax again.
Down the track
separately on the assets that they've inherited and it's specie transferred. So that's the K3 event in, if you like, layman's terms. It's a seemingly fairly innocuous, but it can lead. It's a pretty big numbers involved with these capital gains tax events as well, because these are you're talking about a non-resident taxpayer, so you're not getting discounts, you're not got any of the other benefits associated with being a resident taxpayer in terms of capital gains. So they're the consequences.
So you don't get the benefits, but you get the pointy end of the stick.
Exactly. Yeah. And it's fairly easy to get around. And this goes back to the what you talked about, like, as an Australian advisor, we love a testamentary trust.
Yep.
As long as, obviously, as you mentioned, as long as your beneficiaries are not non-resident. One of the reasons you like a testamentary trust is because it's got the asset protection and you can basically, as trustees, manage your outcomes.
Yeah.
With this scenario, with non-resident beneficiaries of an estate, you want to do the same thing, but you can't do it after the event.
Yep.
You've got to think about it before you write your the last will and testament is actually properly endorsed and signed and put into action. And that's not always that easy. If you think about it, people probably don't review their estates often enough.
No.
Their estate plans often enough. I mean, they usually do it once and, do a review
set and forget sort of.
You do one at 40, you do one at 50, you do one at 60, and that might be the last one you do. But geez, things change fast, and just some sort of really simple planning things around putting clauses into your will that allow for the executor to sell assets in a flexible manner to fund, the non-resident taxpayer with cash and cash equivalent assets, which don't incur any of our delightful capital gains tax consequences. Just those sorts of clauses will make all the difference in the world. Yep. Or even if that's not going to work or can't work for whatever reason, at least have a provision in there so the non-resident taxpayer is actually copping a reduced share because of the capital gains tax event. So it's not unequal, and it's not actually leaving the burden with the resident taxpayers.
Yeah, so if the estate's $1 million, everyone's getting 333,333, which is 3 parties. 2 of them are resident, one's a non-resident. Yeah. Then instead of receiving 333,333 to the non-resident, he would actually, or she would, get an abridged version, which it's everyone's heard us talk about deemed disposal before. Yes. When you are an Australian resident with shares and you go to move overseas, you have to demarcate that change in asset type or asset class to a non-taxable asset and pay the capital gains tax you've accrued up to that point, and then from there on, you're all fine. Obviously, with going through an estate, same point. There's a capital gains accrual up to that point, and when you cut that off, then from there on, those shares that you inherit are capital gains tax free. And I think there's a bit of opportunity here for both parents, children, and the lawyers to actually get ahead of it, and try and think about this in advance and sort of say, well, okay, if we give you the property instead of the shares, then, and obviously, we've talked about main residence exemption, a lot over the last couple of years. If you inherit a property as a non-resident, you have up until 2 years where you can sell that property, take advantage of your parents' capital gains tax-free status as an MRE, and sell that property. So maybe people need to be a bit more clever in terms of what assets they're being given to what children in what jurisdiction. If you can get given a property instead of shares, there's no capital gains tax liability in the property for the expat, and the residents can get the shares, and they can deal with their tax issues when they kick it down the can down the road with the testamentary trust down the track. So I think it's important that this gets discussed early and often, because we are seeing more and more, and it's a sad part of life, more and more parents passing away now because they are a very large part of the community from a demographic point of view. And this problem's going to get more convoluted with people going overseas. And that's the biggest thing that we're trying to do right now, is just get out there and say, hey guys, may not affect you now, but tell you what, if this happens in 2 years' time, this is the consequences. And if you had that chat now, and I think parents generally like their children. I think if you explain to them the complications of this and how it may not be fair for you and your siblings, you need to sort of shuffle the deck chairs, so to speak, and move a few things around.
And as a financial planner, sometimes that's hard. I mean, the conversation's not hard when we're used to having the hard conversations, but the actual process is difficult. Anecdotally, I had a client in Canberra who, old bloke, lived in Yass, had quite a lot of money, and his son lived in Ireland, and of course Ireland's a tough jurisdiction from a number of different perspectives. So one, for the son, his estate planning would be horribly complicated, but he's not my client, so that's right. And he was a lawyer, so he probably look after himself. Good. But the issue was the father was well aware. He had very good estate lawyer in Canberra, and his father was well aware of the of the whole K3 capital gains tax issues. Most of his money was in shares. Yep. So in portfolio, so I was managing that, and he had a reasonable amount in superannuation as well, and we'd done a downsizer contribution as well. So we basically refunded the superannuation side of things. And his view was, I'm 82, JB, we need to get this money out to the kids, and he's trying to distribute to the kids. But we had the problem was the portfolio was growing faster than the distributions.
Yeah.
And it's not unusual, and that's why you've got to have really top-notch will drafting. So even if you think that you could sell everything and give it away before you die, it's not always going to be the case. There's capital restrictions on gifting into Ireland, which is what slowed everything down. It was the big issue. So we could only receive, I can't remember the exact numbers, but it was somewhere around 50,000 a year. It was all we could get into the sun in Ireland. And of course, the portfolio was growing by more than that. And his daughter was probably keener to get her hands on as much as possible.
Yeah.
But it just could never happen. It was just a really painful exercise. And it just brought the K3 CGT thing was really brought home with this, because, he'd been a client for a long time. There was a large amount of embedded capital gains across the portfolio, and which was going to be an issue for the guys. And so the will had a K3 equalization clause, which, basically says, something along the lines of, the gifts to the non-resident will be reduced by the amount of the tax that's been caused by, their participation in this. And the condition of any transmission of a gift is that there's a reimbursement from the beneficiary of that amount of tax. But these issues, of course, they keep financial planners, to be honest, they keep you and I in business in a sense. This is the complexity people can't normally deal with.
Yep.
And it also keeps the lawyers in business because we can't do it.
That's right.
But typically, clients need both of us, around these issues, because the lawyers don't always understand the investment side of stuff.
That's right.
And they don't necessarily get the tax stuff all right either. So it's really important that we, that we're involved and your solicitors are involved.
Well, that's often what we say. We play well and nice with everyone because there's a nice demarcation between duties and responsibilities. And I remember having a conversation about a year or two ago with a couple, elderly years, now starting to think these sort of things, and we got talking about these sort of topics and how they didn't want a inequitable scenario to play out for their children. And I said, well, if you want to keep things really simple, and and they can see their eyes lighting up, because they just were overwhelmed by the choices.
Yeah.
I said, why don't you start selling down assets? You start paying the capital gains tax. So by the time you do pass away, it's cash, apart from your principal place of residence.
Yeah.
And then there are no tax issues. And I've gone, I didn't think of that. Yeah. So sometimes the simplest way is the best way. Like there's a lot of different scenarios, or you might take a hedge approach. If you've got a portfolio that comprises property, shares and cash, then you may start selling down the shares, in your later years. And Murphy's Law always says that if you do that, you'll live longer than you think. But
that's right.
it's a consideration, isn't it? That people need to consider it. To me, it's trying to work out what's in their best interest. We can give clients an Excel spreadsheet answer, but it may not map to personally how they want to handle it.
Yeah, because it's interesting, because I know a lot of American financial advisors basically have their allocation to cash and fixed income almost at the same age as their client. So if the client's 80, they've got 80%
cash. Yeah.
Now, I don't believe in that, partly because people, like you said, people can live longer than they think, and you end up running out of money. And especially if you think at 50, you've got 50% of your money in cash. I mean, that's just
ridiculous,
disastrous. Yeah. It seems to be a pretty dumb idea. But in this sense, I've actually done what you said, which is sell down and almost circumvented the will If you think about it, you could, especially if you've got a couple, like an elderly couple, the first person dying can be almost a non-will event if you've got joint accounts everywhere.
Yeah, by way of survivorship.
Yeah. And of course, superannuation is a non-estate asset, so that just goes to where your
binding death benefit nomination.
Your nominations dictate that. So you can do that, but it's when you've got one parent left, that will has to be
rock
top
solid.
Notch.
Yeah,
rock solid. Deal with these issues. Deal with if you've got. I mean, there's no real reason a lawyer can't do hybrid will, in the sense that a will that actually has a testamentary trust for one kid or one beneficiary, and no testamentary trust for the non-resident beneficiary. There's no reason you can't do that, and especially if you've got brothers and sisters in Australia that are of maybe in small business or high risk occupations, you can still do that and protect assets, or family law matters, any of the other things that cause us to want to use testamentary trusts.
Yeah, and I think the name of the game is all these problems can be solved, some more simply than others, but they're not impossible to solve as long as they're done before. Once the event happens, that's when we don't have a time machine. We can't go back in time and fix things up. It is what it is, and certainly I was having a conversation with a client this week about assets and what assets he should consider, because the parents are going through a revision of their will. And when I gave him the answer, he's like, I'd never even thought I could do that. It's like, yeah, of course you can, because at the end of the day, it really comes back to and people like that nice cookie cutter approach of just everything by a third if there's 3 siblings, and then it's all done. The problem is, if you do want a particular asset and not another asset, then what's to say what values those assets will be at a future point in time? So whether you need to have something else in there, which is like an equalizer, to say if an expat inherits the main residence and the others inherit the shares, and the main residence falls by 30%, then they'll kick in some of the shares. Well, I don't know. And it wouldn't be too hard to work out, because that property essentially is going to get valued anyway. So you've got that demarcation in time. But you can sell the will's going to start to get quite thick in terms of complexity.
But even though, I've had a number of clients that have complained about the price of complex wills at the time, and I've always said to them, if you think this is expensive, you can't imagine how expensive it is if you get it wrong.
Yeah, the tax bill.
The tax bill, the legal ramifications, the breakdown of family relationships is all a possibility if you get your will horribly wrong. So it's worth spending the money. It's not, and in the scheme of things, it's a drop in the ocean. It's not even 1% in almost in any case.
I mean, if you're spending 5 or 10 grand to get this dealt with, and the capital gains tax liability is 200 grand.
Yeah, it's nothing.
Yeah, it's a no-brainer. And these can all be situations that you can avoid and adjust, and nothing's impossible. And I think that's the big thing. What we always talk about with clients is, if you keep a strategy simple, it works.
Yeah.
If it's built on a house of cards and complexity and smoke and mirrors and all this sort of stuff, and the sun rises in the west and sets in the east, then that's when things are going to break down.
Yes,
and it was doomed from the start.
I think that's right. I think that's one of the bases upon good planning, good financial planning, in a sense, is actually the big idea should actually be pretty simple.
Yeah.
What comes underneath it, that's fine. That's a job for professionals to do.
That's the execution side. Exactly.
Right. Yeah.
Yeah.
But the principle and the philosophy should be something you can get your head around and understand.
Yeah. Look at the quantum needs to be all about fairness and equity. Yeah. And if you can deliver that through a properly structured will.
Yeah, I remember, this is going back a while, but I had a client on the Gold Coast in Australia who was, pretty rich guy, and we went to, I won't mention the law firm's name, but we paid for a pretty sophisticated piece of estate planning work, and when we got it back, my business associate read it. And he said, have a read of this. And I read it. And I thought, was something wrong with me because I didn't understand it.
Yeah.
And I went in and I said, I don't understand it. And he says, either do I.
Yeah.
So we got the client in and said, you want to read this? And the client went, I don't understand it. And so we rang up the lawyer and we said, well, firstly, we don't understand it.
Yeah.
Secondly, we've tried to trace through what you've done and we don't think it works.
Yep.
And this is the people that were top notch all over the media and all doing all the conferences about estate planning and that.
Yep.
Anyway, we got the lawyer and sure enough, he says, no, it's wrong.
Yeah.
It won't work.
Yeah. And then the sort of wills that always get contested too, and that's the thing, if you keep it simple, you can have different rabbit holes spinning off here and there. But if you keep it simple, and the quantum of the will is simple, then there's nothing to contest. It's black and white. But it's when you have that grey space here and a grey space there, and you may have siblings that are begrudged or angry, or you just got to tie yourself up in knots for years to come, trying to get the result which should have been achieved early on if they kept it simple.
Yeah, that's right. So simple is best in philosophy. Execution, you just got to leave that up to the people that know what they're doing. And I can imagine, with just some of the circumstances we've seen, recently here and over our careers, that this is going to become more complex, not less complex. The succession piece is going to be
100%.
Almost our most important role in helping clients is going to be succession.
I completely agree. You got the largest transfer of wealth ever occurring, and done incorrectly, you just got to get undesirable results. And as we always talk about, we're trying to find tax optimized solutions and those sort of scenarios. And on the two-dimensional side, it does work in both ways, in that it's what's on the Australian side and what's on the other side as well too. I mean, luckily, US doesn't have inheritance tax, which is good. So the big one is solve Australia, and the rest, sometimes depending on your country you're in, you may have to pay the piper. But what you don't want to do, and I have seen this before, is someone has a undesirable result in Australia and there's no DTA with Australia, double taxation with Australia, so they actually get a bad result. A bad result, and it was a disaster. They lost probably much about half their estate.
I just, when I was doing some research on this, I found that most countries have estate taxes. They're and Ireland is the worst. England's the second worst in terms of the sheer
15%.
Number. Well, it's 40% in Britain.
Oh, sorry, 15 years. 40%.
40%. And Ireland's worse because the threshold's lower, mainly because it just kicks in earlier. There's some fairly dramatic wealth impacts. And
people don't realise that. People don't realise that capital gains tax is actually inheritance tax by stealth, because it's forcing a crystallisation of an asset. So people say,
and the super taxes.
Yeah.
I mean, we're not even talked about that, which is the taxes on superannuation to non-financial beneficiaries.
That's right.
That's almost another subject.
And I think we'll leave that for another episode, because that's we could go on for another hour on that one there. So I think let's hold it off onto another one. But you're right. I mean, we're now getting into that Pandora's box of what about this, what about this, what about this, and it does get more complicated. But I think, to me, the reason why I want to have this chat on the call is, just to highlight to people, hey, it's not as black and white as you think it is, especially when you're an expat.
Yeah.
So, mate, let's leave it from there. Bit of housekeeping. Thanks to everyone who's starting to send in a bit of Q&A. We'll start to address those in future episodes. And also thanks for folks for doing by the way, the Q&A, if you do want to send in some questions to get some answers, link below, and there's a link there to a Q&A form. And also, please keep up the reviews, guys. It really helps us to just get that voice out there to other expats. And as you can see from today's call, we're just trying to educate folks and making sure they're making the right calls. So, mate, I'll leave it there. Thanks, JB. Appreciate you coming on the call, mate, and we'll catch you later on.
Good on you. Take care.
Thanks, guys. Take care.
Cheers.